Greg, welcome back to the show. Always a pleasure.
Great to be here, guys.
So, I don't know if you remember this, but you were with us before, and I wrote down a bunch of dates that you suspected would be very important. Um, Among them,
And that was in January.
that was in
right?
January. That's exactly
Yeah.
right. Um, and you wrote, let's see, 2/14, February 14th, end of March through April 1st, June 16th through June 21st, and then as we speak, we're getting near 8/25 to September 5th, August 25th to September 5th. What are all these dates, man?
Yeah, I get that a lot. So, as you guys know, I do things a little bit differently than most traders, investors, analysts, and I look at time cycles and price action. Those are the two catalysts for how I trade, how I invest, how I look at the market. And it's all based upon old school trader named W.D. Gann, who I call a master of time analysis. And so each year there are certain inflection points that happen, and based upon long-term cycles, based upon short-term cycles, I like to review what those are likely to be. Now, whenever a lot of people hear, well, oh, Gann, it's going to be this major crash or this major bust or this major boom or this major bottom. That's just not how it really works. Okay. I'm just looking for inflection points to trade. And then as we go through the year, how the market trades into those inflection points will determine whether it's, a big inflection point or just a pause or something else. So like you just mentioned, that those June time factors, right?
Mm-hmm.
So, I'm looking up here, look at where NVIDIA made its high. That was on June 20th. All right. And it hasn't, and then it is starting to pop back up into next week. They have earnings coming out. Now, I'm not going to sit here and tell you what earnings are going to be. It could be great. And then it pops up, but it's within that window of 825. And I didn't know when NVIDIA was releasing earnings, back in January. But all these things start to come together when you study time analysis, and it takes a long time to do that. And it's a lot of work, it's a lot of energy. And another thing is important is I don't know whether it's going to be a low or a high. We don't deal in guarantees, we deal in probabilities. There is no holy grail. But what my strategy allows us to do is narrow those probabilities down, manage our risk, and say, hey, this is a really, really good risk reward opportunity. We're going to go long, we're going to go short with calls or puts or whatever it might be. So what I find interesting, again, just using NVIDIA, which everyone knows of now, it topped on June 20th. We're seeing a bottom and a rally. It happens to be right into this, late August, early September timeframe, or time cycle rather. So if that happens to be a high, that is a situation where I'll probably look to buy puts.
Okay. Well, let me get my pen out. Do you have the next set of dates for me?
Yeah. Well, again, so we're looking here at the end of August. So, back in January, I mentioned 825. So let's call it 825 to the week of Labor Day. Okay.
Okay.
And next week, I'm going to, for 10 Stock Trader subscribers, Alliance subscribers, obviously you guys will read it. Go over certain scenarios. Okay. Is this going to be, and not all tops look the same, and bottoms happen to be, easier, if there is such a way to describe it. Look what happened just earlier this month, right? We saw this huge move down in late July, early August, and boom, it was a one-day turnaround and we spiked higher. That is quintessential bottom type of move. Tops tend to make a little bit more of a process. And now again, this top doesn't necessarily mean it's going to be the top. Okay, so if you held a gun to my head and said, Greg, what is this going to look like? Basically what I'm expecting is, if this rally continues into next week, possibly into right after Labor Day, okay, we may see the Dow top first, and semiconductors top last, or reverse that, or small caps start topping out first. They've struggled mightily over the last couple of years, while semiconductors and NASDAQ and even the industrials have rallied to new all-time highs. So I'm not going to sit here and tell you exactly how that's going to play out, but when I see those divergences develop and I've gone over this over the last few weeks with subscribers, and then I see that happen into these time cycles, oh man, I get really excited. But okay, so after that, what I find interesting is right before the election, late October. So let's call it. Let me. What's the actual calendar here? Let's see here. Right. So let's call it, and you can write these down. Let's call it October 24th to October 29th.
Okay.
Right. If we make a low into that right before the election, I'm probably going to start buying it. And that has nothing to do with my political bias or whatever. And we all have bias. Yeah. And I think that's what's so important about my strategy is, I don't get caught up in it. Yes, we all have things that we want to have happen, especially when it comes to politics, especially now with emotions running so high and the country's so divided. We can get, you can get into that till the cows come home, right? Mm-hmm. People are going to believe what they want to believe. And then they have certain biases about, well, this person should win and then the stock's going to do this, or this person should win, so bonds are going to do that. Right. I have to remove all of that. We all have those biases. But what I really love, many things, but especially a time now when emotions are so high, when we have, a big election like we do, it just, I tune out all the noise or what I want to have happen and strictly focus on the cycles and the price action. And that allows me to, control those emotions and just focus on what I need to do to win.
Yeah, well stated. We, we hear similar from every trader who has a system that they've used for years and years. One of the prime benefits is getting the emotions out of it, and God knows we all need to do that. It may be, given that the biggest risk is your own human nature, that's probably what we all need to do more than anything, is to get the emotions out of our investing and our trading.
And it's interesting you say that, and a lot of people say you need to remove the emotion, and that's definitely the right path. I like to say it's controlling your emotions, because we're human. We have emotions. Right. It's like, well, I'm going to completely remove all my emotion. Well, no. What, are you a cyborg? Are you a robot?
Right.
No, you're not. You have emotions, right? Like, I just love it. It's like, all right, I bought a stock and the next day it's down 80%. I don't have any emotion. That's BS. Of course you have the emotion, right? You're like, what the heck, right? Yeah. But being able to control it and say, all right, I'm down. And I always like to say, always focus on what's next. Mm-hmm. Whether it's, all right, this is a spot where I'm going to add, or I'm just going to cut it and then I'm just going to, move on to the next trade or the next investment or whatever it might be.
Yeah. Right. I mean, I've found more and more that, investing, trading, especially, more than me, but like psychology, a lot of it more than anything, like, you can't be an emotionless cyborg. The whole point of managing risk is to handle those emotions. And like, that's a practical way of handling it. I think is
and having a strategy helps you do that. It helps you say, all right, look, I'm focused on my strategy, and there's no holy grail again. So you have to incorporate risk and losses into that strategy. But once you understand that losses are part of the game, they don't bother you anymore. Or of course they bother you, but it's just, all right, again, and I like to always say, I'm going to focus on what's next. And that's part of the strategy, and that's how it works, and that's how you string some of those trades together, wins and losses, and then if you have a winning strategy, that's going to overtake any losses that you have, and then you move forward.
Yeah, I guess you don't want to be losing, every time, 100 times in a row,
right?
But
you
gotta get some wins in there, but yeah.
Right. Then you got to change your strategy. That's right.
Right. Yeah, it's magnitude of gains versus magnitude of losses and average returns over time. But I'm reminded of a guest that we had named John Netto, and like he's in one of the Market Wizards books, and all the almost every trader we talks about minimizing emotion and not letting emotion sort of screw up your trading, basically. But he was the one guy who said he tried very much to use emotion in his trading, which it's like, once I read that, we had to get him on the program. Because it's just, we had to get him on the show, because when a trader says something completely different from every other one, And I'm telling you, traders, and you know this, Greg, I'm not telling you anything you don't know. They all have different strategies. They all have something different. And yet they all say the same core stuff, risk management is more important than, exits and entry, you're not predicting anything really. Your strategy tells you when to exit, when to, enter, when to exit. And your risk management, your position sizing, your stop losses, all that stuff is 10 times more important. They all say the same thing, but and they all say similar things about emotions, but that one guy said something different about emotions. But that's not what you're talking about. You're talking about, controlling them and managing them, acknowledging that they exist, I guess is what you're saying. They exist. You're not a cyborg, but you have to manage them.
Correct. And I can get on board with what he's talking about, using emotion, and that comes with experience. And for example, last month, huge sell off, everyone starts freaking out. You can almost feel it, right? You go on social media, you can feel it.
Yeah.
That using that type of emotion, or maybe other people's emotion or investors' emotions, like, all right, I'm taking the opposite side of this, right? That comes with experience. And that doesn't happen all the time, but I can see where he would say, this is where I want to use emotion. I agree with that.
Yeah.
But the majority of the time, I would say, you're kind of in your own zone. I like to say I'm on Greg Diamond Island. Like I just kind of put all the noise outside, and I leave it outside, and I just strictly focus on what I'm looking at, what my strategy is telling me, and then I just execute.
Right.
All right, cycles.
Strategy, execute. It's just, yeah.
Yeah. I mean, obviously, we know you deal with cycles. We just talked a little bit about that. What do you make of the election cycle that is, and maybe explain that a little bit, if anything is significant about it?
Yeah, well, this is what I'm going to be reviewing or going over in the next my next event, which is on the 27th, and you can sign up. I'm sure we'll have a link here for you, but I'm going to be going over essentially I'm not going to go into everything specifically, but I'm looking at the presidential cycle going all the way back to 1896. Right? And how that cycle, which is a very long cycle, obviously, but how that cycle plays into what's happening right now. And again, what the cycle is telling me, that's a very long-term cycle. I'm also going to talk about short-term cycles and then how I'm going to be trading that. And I mentioned it a little bit at the start in terms of, look, if I have the short-term cycle here coming into late August, early September, if that continues to rally into it, that is a selling opportunity and a chance to buy puts. Again, it can only last for maybe 3 weeks. That's the ideal scenario. There are a couple other scenarios that I will be reviewing next week for subscribers. But again, the election cycle will be all right. So many people are going to be talking about. Well, they already are. All this policy versus that policy. What happens if stocks? Or what happens if the Democrats win versus what happens if the Republicans win? What happens if Congress switches but the president doesn't, or whatever it might be? There's so many different scenarios that can unfold. Here's something that I think your subscribers or your listeners would like. What if I told you the cycle's already in and it doesn't matter who wins? That would be kind of crazy, right? So,
not to me.
Yeah, I know it wouldn't, Dan. So I'm not saying that it wouldn't matter politically. I'm saying from the stock market point of view.
Yeah, I don't think it'll matter politically.
The fix is already in.
That's a different topic.
No. I agree with you there. And I understand what you're saying. But again, that's where kind of the bias comes into play. Mm-hmm. But again, for me, if this plays out the way that I think it is, it's not. Yeah, it's a spectator sport in terms of the politics. But I'm looking at it in terms of the market and what's going to happen, and I'm looking at it from the short and long term cycles, and that's really bad. That's really it.
Right. Even if it sounds like even if someone could look at it and say, well, if Harris wins, then it's going to be this, and if Trump wins, it's going to be that. I feel like even if they were right, whatever happens is you're going to look at in terms of these time cycles, and it's not going to matter whether it's long or short or somewhere in between or some spread trade, or the time cycles are still going to be there. Human nature is not going to change
Correct.
because one or another gets elected, right?
The time cycles are still going to be there. And what are those time cycles based off of? They're based off of how humans, or investors in this case, how they react to certain things, what those emotions are. And those emotions really, they go in waves, right? It's not static. There's ebbs and flows. There's longer emotional reactions to some things and shorter emotional reactions to some things.
Right.
But when you put all those cycles together, it gives you a blueprint almost. And it's not perfect. Again, there's no holy grail, but it improves my probabilities of saying, hey, look, if we get a low into the election, I don't care who wins, I'm buying it, right? If we get a high into Labor Day, something might happen. Like I'm calling it the early, the October surprise comes early, and that starts spooking investors. And that's what the cycle analysis is telling me. Now there's cycle inversions and things like that, which I won't get into, but generally speaking, the cycle is going to tell me on a broader perspective, a 10,000 foot level, what to expect. And that's how I'm going to manage my risk.
All right. So we're talking about these cycles, and we're kind of talking around them. I wonder if you could give us a sort of like a, the Gann for dummies, like WD Gann for dummies, in 5 minutes or something. Like what can you tell? Like, is there a century long cycle that inside of which all these other smaller ones? Is there just an annual cycle and lots of shorter ones inside? What are the?
Yeah, I mean, you just answered it.
Oh, really?
But I'll give them more specifics. Yeah. Okay. So there's a very important 90. I'll give you all the major, and this isn't. I was in Vegas last year, and I gave a speech, and someone said, "Well, how can we learn more about Gann?" I'm like, he's got books on it. He has tons of books that he's published. I'm not in some secret club. Yes, I'm obsessed with it. I've read everything on him. I study it. I do statistical analysis on it. We have computers now. We can test these cycle theories. And so, I would love to know if he was still alive, what he thought about, hey, this is what I said without using computers. It's kind of remarkable, actually. And how you can test it now. And it's really remarkable how he was right and how he continues to be right. So that just proves that history rhymes, it repeats, and these cycles repeat. Now, how you apply those cycles is where it becomes important. Well, when do I use a 90-year cycle? When do I use a 20-year cycle? When do I use a 10-year cycle? But to answer your question, Gann for dummies, the most important cycles that he looked at are the 90-year cycle, 60-year cycle, 30, 20, 10, 4, and then the annual cycle. And again, I test all these statistically through a system. I look at them even just manually. Like, all right, so for instance, let's look at a 60-year cycle from 2024. So how would I analyze that? All right, and it's really simple. It's 2024. I go back 60 years. What happened in 1964? And somebody might say, well, that's really simple. Like what? I don't care why. Why does it work? I don't care why it works. Does it work? Is there a similarity between what happened in 1964 stock market and what's happening now? Go back and look for yourself. You'll see that there is. Okay. Go back to 1934 at the 90-year cycle. See the similarities in the dates. Okay. Look at for yourself. Study this stuff, and you'll be blown away about. It's not perfect. It's not a 100% correlation. But I go back to 2022, where I probably had my best year ever, at least at Stansberry, certainly. And I nailed that bear crash or that bear market rally, or rather. And how did I come up with that months in advance and trade that whole market cycle for an entire year? I looked at what he called the master cycle, which is a 20-year cycle. And I go back and look at 2002 versus 2022. You'll see unbelievable similarities between that market structure. So that's kind of the Gann for dummies to start off with.
Okay. Well, it seems simple enough, doesn't it? It seems simple enough to just start with 2024 and go back 1 year, 4 years, 10, 20, 30, 60, and 90, doesn't it?
Correct. Now, again, this is where and Gann talks about this. I mentioned it briefly earlier. There's things called cycle inversions. And, that can get where things get tricky. And what is a cycle inversion? Basically, let's use the 64 versus 2024. So if I'm expecting a high in June, but markets are actually trading. So there was a high in 1964, whatever, let's call it in June. But there was a low in 2024, right? The dates are the same, but the price action is the opposite. That's the inversion. So
Okay.
instead of a high, you get a low. So it gets a little tricky. It's not just because think about it, right? If it was 100% correlated all the time, everybody would be like, "Oh, this is great. I'm gonna buy my own
Yeah.
island." It's not exactly how it works all the time. So there are nuances to it, but again, that's the general. When you start with Gann analysis, that's what you start with.
As we sit here and speak, I've just I'm putting together the I guess it'll be the August issue of the Ferris Report, and it's all about the story I'm telling. If it makes it through editing, is all about um, a mathematician named Benoit Mandelbrot, who, or Mandelbrot, however you're supposed to say it. I don't pronounce French very well. And it's called The Misbehavior of Markets, a Fractal View of Turbulence. And he studied turbulence, which we call volatility. And, and of course, fractals are self-similar images, among other things, where the smallest part of the image is identical pretty much to the largest part of the image. And this has a vague whiff of fractalness to it, simply because all of these years, if you I just write them out, um, they are in some proportion to one another. Whether or not that proportion means anything, it probably means nothing, right? I'm not saying it means anything, but this smells familiar to me, I guess, because I've had my head in fractal geometry for a week and a half. And it doesn't surprise me. Like you said, it's amazing that Gann was right in, whatever time he lived, before computers were used the way they are today. And, studying markets since, 1896 or whatever. And it, it is amazing, but it doesn't surprise me. One of Mandelbrot's, what he calls his 10 heresies of finance, are that markets are the same in all places and all ages, meaning all times. And I think
I
that's
love that.
yeah, I think that's lost on people.
love that.
I have people telling me, this CAPE ratio you keep talking about, it doesn't work anymore because blah blah blah. I'm like, well, I'm pretty sure human nature hasn't changed since 1929 or 1896 or 18. I think they started 1870, that data. And
Greed and fear.
yeah, so, maybe the numbers are a little different, but the action is crystal clear. It's unmistakable that the CAPE ratio is absolutely in the stratosphere at the top of all the biggest bubbles. Like, you can't mistake it. The rest of the data is probably not worth much. It probably has no, real predictive value at all. And even CAPE, it's not a precise timing thing. It's just the tenor of the time. It describes what's going on overall. So, what you're telling me, Greg, makes a lot of sense, because you're doing what a lot of traders do, which is you're refusing to pinpoint and be dogmatic and say things very specifically. Because if you did that, I'd know you were full of bullshit. But you're not.
Right.
You're saying
No.
it's not that precise. It's like it's not a story we tell about the market. It's a story that the market tells us. That's what Mandelbrot found. I think that's what Gann seems to have found, and that's what you're using. It's what story is the market really telling us? Don't impose your own stuff on it.
That's a great. I love that, and I say it often, or at least privately, and I'll say it publicly now because it's true. A lot of people like to say, especially as a technical guy, a cycles guy, time and price, whatever. Again, it's totally different. I'm like the redheaded stepchild that nobody really pays attention to, which is fine. But I don't try to convince people of what works and why it works. All I know is that it does. And I've been doing this for over 20 years now. Right. So I'm going to present to you the facts. This is what I'm looking at. And this is what I studied. And this is what I'm going to do. And this is my track record. If you like it, awesome. Great. I hope I motivate you. I hope you follow me. and we'll it's not going to be a straight line of happiness and champagne bottles and Porsches, but it's success. And if you don't like it and you're more comfortable with the fundamental, okay, great.
Yeah.
But what drives me crazy is people who have such a closed mind and say, no, this is the only way to do things, and anything other than that just doesn't. It does. They've almost, I'm not gonna say brainwashed, but they're just blinded by what else is possible. They don't have an open mind about what is possible, right? And so I just I've I don't know when, I can't specifically say when I'm just like, because I used to be, no, you guys gotta look at this, now I'm just like, look, this is what I do, this is what I've studied, this is what has led me to success, and again, if you like it, awesome. If not, follow someone else. But don't criticize something that you don't know. Don't criticize something that you don't understand or haven't studied or haven't traded or haven't invested in, simply because it may be a little bit different from what you're used to.
Right. In many ways, more than one way to skin the market cat.
Right.
Yeah. Yep. That's a good point. It just doesn't do you any good. It does you good to decide what your style is, what fits your personality, your way of seeing the world. But it really doesn't do you a lot of good to go around criticizing other things that work for other people. I'm sitting here as you're talking thinking, yeah, I remember the time I heard Stanley Druckenmiller, who's like crushed it over time, made billions and billions and billions of dollars, one of the most successful investors ever. And he says, well, we look inside the stock market, how the action of different industries, and we look at the macro and the Fed and all this other stuff. And then he says, and all the rest is technical analysis. So,
yep.
No matter you can't tell someone that they haven't made the money they've made the way they've made it. You know what I'm saying? It's just, it doesn't pay. So, and I get the same thing. Look, if you want to talk to somebody who's been criticized, talk to a value investor.
Sure.
Everybody says it's dead. People are always saying it's
right.
dead. I just wrote a whole digest about how it's not freaking dead.
Yep.
You just have to do it. And so yeah, I feel you on that one. It's a really good point, and it goes to another point. Every now and then I'll write about how your investing is a personal thing, and your trade, whether you're a trader, an investor, a real estate investor, a stock trader, whatever it is, that's up to you. No one can tell you that. No one can decide that for you. And I like your sort of take it or leave it kind of attitude. You're not trying to proselytize. You're just showing people what you do and how it works, and it does work.
Right.
So,
and go back to Stanley Druckenmiller for a second.
Yeah.
Some people were probably blown away that he would say that the rest that he uses is technical analysis.
Yeah.
But let's think about what that is. And it kind of goes back to the start of what we were talking about. You look at a chart, and all it is human emotion and decision making within a stock or a market expressed on a chart. Mm-hmm. That's what it is. That is the emotion. Those are the things that are happening. Well, what about algorithms? Well, who made the algorithms? What was it based off of? All those algorithms are based off of what happened in the past.
Yes.
Right? And humans did that. So, yeah. I mean, that's the fundamental principle of technical analysis is that, yes, it's the fundamental understanding of how humans behave expressed on a chart, and then those happens in patterns, and then those patterns repeat or right. rhyme.
There's another point in here too, which is when you said you don't know why it works, you just know that it works and you know how to work it. You're a race car driver. You're not an engineer building engines, right?
That's a great way
You're
to
not
put
a
it.
physicist teaching an engineer why the stuff he's doing in the engines works even, and asking why is wonderful. I have no problem with asking why. But when you say you don't know why, that's good. That means you know what you're doing and what you're not doing. What you're not doing is at least as important as what you are doing in life. And that's a point
right.
worth noting, I think. You don't have to know. Like, I was thinking about this in relation to, of all things, love. Why do you love someone? And I think, when you're in love with someone, the real answer, the correct answer, is I don't know, but I really know that I am, because there's 8 billion people in the world, and half of them are the other gender. And, not everybody falls in love, whoever you fall in love with. Let's just say, I'm a man, I have a wife who is a female. So we'll stick to that model. And half of them are women.
Careful.
No. I'm just saying there's 8 billion people in the world, and 4 billion of them or so are women. So, you can't, just don't take this one away from me, is all I'm saying.
Right.
Like, I don't want any of the others. I know that I want this one, and she's for me. So it's not knowing why is okay. And you can be very successful doing what you're doing and not knowing why it works, I think. It's important.
Dr. Dan.
It's important
I like
to know.
it, Dan. Yeah.
Dr. Dan.
Well, in some ways, it's, if you don't know the why, it's a little easier as well.
Well, sure.
100%.
To just kind of
100%
be going through the process and not overthinking too many things. But Greg, I think I'm going to start calling charts, maybe fear and greed, emotional calculators.
Yeah.
Maybe that's what we should start calling charts rather than technical analysis. I
like that. I like that.
Yeah. We got to think of a good name there. That's good.
It's one of the things, like, so, I'm not a conventionally trained, investor, trader, or, whatever it may be. But when I first started getting into this and learning a bit about it, you had the fundamental analysis, which I kind of understood, why you want to value a company, right, to begin with, like Dan, has done forever. But then okay, great. But you buy this, then the price, moves whatever direction it does in 3 months, 6 months, and you're like, oh crap! Like, what did I make a terrible decision here? On this. This is me, amateur Corey, talking, right? And then I came across technical analysis, and I don't even know how, really, but I was like, oh wait, there's these kind of price action short-term indicators, long-term also, that at least to me made a lot of sense. And there's a lot of circumstantial evidence, as you know, with Gann cycles or different strategies, that at least made me comfortable. It made me more comfortable buying and selling and making decisions, whether that was right or wrong. Like, it at least gave me a nice framework to start with and be like, okay, even if something goes wrong here in the next 3 to 6 months, at least I have a strategy to begin with. So I think maybe for some people that have never thought about technical analysis before, that could be something, it just gave me like a little sense of comfort at the beginning when I was starting out.
Yeah. And I make it a point to, what do you call it, educate or just inform. It's not just, in my service, I'm saying, hey, buy this, sell that, just because I told you to, and that's what the chart. I outline in detail, definitely every week, if not every day, at least something that I'm looking at in terms of, all right, this is, I have a whole suite of videos and special reports and the whole lot. So, I go into the depth of technical analysis, and, you kind of go back to your original point, like, all right, Dan sits down and values a company. Well, how many millions of people around the world are doing the exact same thing or maybe not millions, but whatever number it is, thousands, hundreds of thousands, are doing the exact same thing. And what are the chances that all of those people come up with the exact same conclusion? It's zero. They're not. They're going to come up with different conclusions about how that market works. Yeah. Well, what does that do? That creates volatility. That creates the emotion. And that's where technical analysis takes over.
Yeah, it's an art.
Or not takes over, but where it's useful.
Yeah. And
so, and I like the way that, and I'm sure I say it all the time. I think I've said it to you guys before, but, Market Wizards, Paul Tudor Jones, my first boss worked for him. He famously said, I believe price comes first and fundamentals come second, or price comes first and the news or some catalyst event comes afterwards. And that's a difficult concept to grasp for a lot of people. And it was difficult for me. Like, what do you mean price comes first? What are you talking about? And basically what it means is the market's going to discount certain things into the future. It's already going to, get ahead of it.
And what?
And I think that's why technical analysis is so powerful. Is it's the collective behavior again, and you can spot these trends, these patterns, these tops, these bottoms, these cycles, and use it to your advantage.
And what I find fascinating about all of these things, now that we're mentioning them all in the same breath, valuation, value investing, let's just say momentum, Gann cycles, anything else you want to throw in there. These are not sciences in the way that physics is a science. I mean, you talk to a physicist, a knowledgeable physicist, and he'll tell you exactly how the heavenly bodies will move, and they can blast a rocket off and pinpoint it on a spot on the moon or whatever. It's amazing what they can do. They measure it precisely, and none of these things are like that. They're all arts, and there's art and a lot of discretion and sort of feel to it, even though you are looking at a lot of data, which is very interesting, I find. So it's interesting how there's emotion in all of it. There's bias in all of it, right? So that hence, as you point out, volatility. We can't predict these things. You said that before. You're not predicting things. You're just working with the probabilities based on, cycles, potential cycle inversions, whatever's happening at a particular time, based on market action. You're trying to put the odds in your favor. You're not pinpointing a particular place in time and space the way, I described that a physicist might do. And I think that's lost on a lot of people. I think, Corey said, it was talking about technical analysis. And what I've seen is, and I saw this in myself too, the very first thing a lot of people try to do when they decide they're going to become investors, going to become involved with the stock market or commodities or whatever, is they look at price charts and think that there's a way to pinpoint and predict the price movements, and I think that's a typical thing because it's an availability bias, right? That when you don't know anything, the only thing that's available to you is the price. So you got the price staring you in the face. You figure, well, that must be the most important data point, so I'm going to focus on that. And there must be a way to predict it because a lot of people are getting rich out here, and they must be predicting. You just make all the usual sort of first level false assumptions, and away you go. And I've talked to a few people who have made a similar progression as I have, and they start from trying to do that, and eventually they make their way to analyzing businesses and wanting to be a long-term investor. And some of them go, kind of the way you have, or the way that our market wizard guests, like, Jason Shapiro and some of the others, even just a lot of the traders we've interviewed, and they say, well, I'm not going to pinpoint anything, but I am going to do, like you're doing, put the odds in my favor by having a system that works, that I understand and can use and reiterate every day. You can go into the market. You have a set of analytical tools that you use, and you gave us the for dummies version of these cycles, 90, 60, 30, 20, 10, 4, 1, and away you go. And I'm sure there's a lot more to it, of course. Now, you don't write whole books to say, 90, 60, 30, 20. So it's interesting to contemplate the art of it all, I guess is all I'm saying.
I think it's probably important to delineate between trading too and like the portfolio that you want to have for a long-term investing. Like,
and that's interesting you mentioned that, Corey, because, like in my personal portfolios, there are stocks that I just don't trade. I just buy them and I never sell them because they've paid a dividend through multiple bear markets, and I just don't touch them because they're good businesses and they pay their investors back. I'm not going to try to trade that. You know what I mean? I mean, you're talking about building wealth over the long term. I mean, my grandfather was amazing at just buying these businesses. I mean, he thought it was crazy for getting into the trading business but he retired so early because he did what you guys do. What a lot of people do is recognize good businesses, keep buying them, holding on to them, getting paid good dividends, and and having that, 30, 40, 50-year approach. So I do a little bit of both. You know what I mean? Now, in the short term, I like it because I can, again, improve the probabilities of, hey, this is where I'm going to, like 2022, 2023, this is where we're going to add to those long-term investments, those really good businesses that are at a value or at a discount. But then also in the short term, trade it and, add alpha to what I do.
Yeah. And it's fun, short-term trading too, right?
Most of the time.
I imagine the election season, well, it can be fun. Right? It can be.
Well, I've been saying it for a few weeks now. I haven't been this excited since 2022 in terms of the market inflection point that I'm anticipating. Again, no guarantees, no holy grail, but the probabilities are very, very high that this is going to be an exceptional trading season, from September until the end of the year.
Okay, and just to be clear, like the big excitement for you begins with this first inflection point that we're calling like late August, early September.
Correct.
Yeah, that's cool, Greg. I didn't know that. I didn't know that you were as excited now as you were in 2022 because, God, you just ripped it in 2020. You tore it apart in 2022. Like nobody in our company could touch you. You were just like, whoa, have you heard about what Greg is doing over there? And it was like that. So that telling me that, now I'm really paying attention. Now I'm really.
That's what, let's be honest, as a trader, as a long options trader, as a time and price trader, volatility is where I'm going to shine. When earlier this year, 2024, for the most part, has been kind of boring. Last week, obviously, or the last couple of weeks were a little more exciting in terms of, volatility. But for the most part, it's just kind of been a buy and hold market, which is fine. But again, when I think volatility is going to start ramping up, and when I say volatility, I just don't mean a big crash. I mean moves in both directions.
Yes.
Yeah. So that's what I get excited about. And that 2022 was that. I mean, we had big moves down. We had these huge, short squeezes. It was a wonderful trading environment. I know not all investors liked it, especially if you're buying and holding and watch everything going down, 30, 40% or whatever it was. But those are the environments where my style of trading is going to do well.
That's interesting. I mentioned the issue that I'm working on for the Ferris report. And I agree that higher volatility is likely in the next, in the near future. And I was just the simple observation that really kind of put things together for me was when Mandelbrot said volatility clusters, right? It tends to cluster.
I like that term.
Yeah. So, we had this tick up, and at first, I found some research that said that the spike in the VIX that we had recently, I forget the date, was it the 12th maybe? When it went up to 65, they said, well, no, it didn't really go to 65 because there was a mispriced option that was screwing up the calculation. But now I'm seeing that, no, it really did go to 65. Whatever it was a spike, and then it reverted in record time. It's never reverted like that. Or maybe it's reverted like a handful of times in many, many years. I forget the exact
I think it's like statistic. 4 or 5 times in the last 30 years, something like that.
Yeah. So it was a really record, record spike, one of the biggest spikes, and then a record, reversion. And like you say, the volatility goes both ways. So that spike up was followed by what we ought to be classifying as a spike down. So the volatility is still with us.
Yeah, and if I'm right about what happens, I don't think that's going to go away. And again,
I agree.
That's what I'm excited about.
It's funny, isn't it, Greg? We're winding up on the same page, and as investors, we're like nothing alike. You and I have done this before, I think. Yeah. We overlap sometimes like that.
And let's think about, I usually don't like to get into the why, but for argument's sake or on a podcast sake,
for fun's sake,
the market doesn't. The market doesn't like uncertainty, and an election causes uncertainty for the most part. Now, sometimes the market will discount that and say, you know what, this is like a landslide or whatever it might be.
Mm-hmm.
So, but this is a whole new game. The election season has been insane just in terms of, getting shot and Biden dropping out and higher, whatever. Right. But so there's just all these different things that are causing this uncertainty. And people are betting or trading around that, causing that volatility. And that's not going to change. And then you could have, a shift in Congress, whatever it might be. And again, broadly speaking, that probably won't matter in the long term. But in the short term, that uncertainty is causing an emotional reaction among investors and we saw it in the VIX, and we're going to see it again.
And there are other dynamics too, I think, that can be thrown in the why bucket. And one of them, I believe, is passive. I think those flows are completely mindless, and they can flow in different directions, and they've flowed in one direction for a long time. And I think they can cause outflows in other directions. I'm constantly reminded of March 2020 when Vanguard said 1% of its clients abandoned equities entirely. I'm like, man, what the hell does 2% look like if you're down 34% in a month? You know what I'm saying? So I think there are a lot of dynamics here, and just the falling number of equities, falling volumes over time that we've seen. These things can kind of add up and all come together the way the cycles can come together. These fundamental underlying factors can come together and compound one another the way the cycles can come together in time. There are reasons, I think, to be concerned and to expect more volatility.
Yeah, and then if you're me and you're looking at macro a lot, you throw in these couple recession signals that have traditionally worked in the past, that have already flashed. And you're like, okay, well, what's next here? You put these things together, and that's what I was trying to say before. Like, if you have a particular view on the economy or the world or the market, and then you marry the technicals with that, I think that's like a powerful thing.
No, well, that's what Stanley Druckenmiller is a genius at. That's his bread and butter, and he has the macro outlook. He's global macro, and then he adds the technical piece, and that's the reason why he's the best.
Yeah.
All right. If I could just link up with him real quick, I'll go do that.
Yeah, that's right. Yeah. And a lot of people do that too, and haven't achieved similar results. So there must be something special going on there. Either that, or it's just random, and he got lucky. I don't.
Right. Total luck.
But lucky for decades and decades and decades. I think over time the luck kind of changes to skill. But
that's a good point, Dan, because if you think about the time cycles and you think about the technical analysis, sure, some people can get it right, for a month or two or whatever. But can you do it year in and year out? Do you have that system in place where you're going to be? And this is what I pride myself on, if you want to call it that, is that whether it's 2022 bear market or 2023 or whatever you want to call 2024, regardless of whether it's a bull or a bear, my strategy can make money. And I've shown that 2020 with the COVID crash, 2021 with the recovery, 2022, the low in 2023 rally, whatever it might be. And that's based on these time cycles and technical analysis, and showing how the strategy works, which I think is important because it's not a one-off fluke. You know what I mean?
Right.
I'm not drawing trend lines and saying, "Hey, I got this one right." You know what I mean?
Yeah. Right. You're demonstrating. It's an ongoing demonstration of the idea, which we're talking about politics and things. You don't get a lot of. You get a lot of ideas in politics where the ongoing demonstration shows that it's an absolute disaster and no one should ever say it again.
Yeah.
And yet, what are they doing? They're saying it again and again and again and again. Kamala Harris talking about price controls, and we just put out a presentation for the purpose of attracting new subscribers to the Ferris Report based on this book that I have somewhere right nearby called 40 Centuries of Wage and Price Controls. So the demonstration, if Greg Diamond was 4,000 years old and he was demonstrating price controls, he'd be saying, see, it doesn't work. See, it doesn't work. See, it doesn't work. But you're not 4,000 years
and
old.
now they're saying, let's try it.
Yeah, that's right. And you're demonstrating how Gann cycles do work, and you can make money with them,
Right.
which is good. It's good to have, the rubber has to meet the road, right?
Right.
And it does.
Yeah, but
All
don't
right.
worry, Dan.
Well,
It'll all pay for itself, they also say. So it's
yeah,
fine.
yeah. I know. They say magic words, magic incantations. Intone the proper political incantation and get the votes. And the fact that none of it is true, we'll work it out later. But it's time for the final question. You've answered it before. And by all means, if you've already answered it, feel free to repeat yourself. Just tell us your answer again. That's fine. The question is the same for every guest, no matter what the topic, even if it's non-financial. Very simply, Greg, can you tell us if you could leave our listener with a single idea today, what would it be? What would you like that idea to be?
Well, I usually say manage your risk, and that's a pretty simple one. But I'm going to switch things up, and I'm going to say, manage your risk, but also be prepared for volatility, because I really believe that it's what we just saw and what's about to happen could last for quite some time. And I'm not just talking about, yes, I'm really excited about, because I only really focus on, I look at every year as a 12-inning baseball game, and I trade each inning, each month. Mm-hmm. So I don't like to get too far ahead of myself, but if I'm right about what happens, it's going to be a volatile next few months and probably next few years. So that's kind of where my, general, and that's exciting. As a trader, I'm very excited about that. So for me, that means opportunity. So prepare for volatility. That's my answer.
All right. Excellent. Excellent answer. Once again, you and I are on the same page. Listen, Greg, thanks for being here. It's always a pleasure to talk with you, man. I look forward to seeing you soon.
Likewise, gents. Thanks for having me on.
As you heard today, Greg Diamond says a historic trading opportunity could arrive just days from now. In fact, tomorrow, Tuesday, August 27th, he's posting his full blueprint for exactly where he predicts stocks are going next, free of charge, and how to position yourself to potentially double your money. We don't say that lightly. You could have doubled your money 10 different times during the 2020 election year by using Greg's recommendation. In short, a rare event on September 9th could upend the Harris-Trump election. It could be lights out for one of the candidates and open what Greg is calling the biggest money-making opportunity of his career. In fact, when Hillary lost in 2016, Greg had the most profitable 24 hours of trading in his life. If he's correct about September 9th, this upcoming event could double your money over and over as it unfolds, as Greg has already shown 37 different times at our firm without touching a single stock. Regardless of your politics and regardless of whether you like this election, I urge you to get a free copy of Greg's blueprint at www.august27warning.com. A surprise event could change the political landscape overnight and bring absolute chaos to the stock market. Go to www.august27warning.com for the full details from Greg. Remember, this is the man who called the 2022 crash a day before it began and once predicted the exact share price of Tesla for a 197% gain in 13 days. So don't miss his newest prediction. If you want to get ready for volatility like Greg suggested, go to www.august27warning.com to at least skim his evidence and get a free copy of his blueprint. august27warning.com.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.